Welcome back to the Deep Dive, where we tackle the densest stacks of source material, strip away all the noise, and really deliver the concentrated, critical insights you need to be genuinely informed.
And our goal is pretty simple, right? It's to give you the context and I guess the critical lens you need to assess these massive, really complex topics quickly and thoroughly.
That speed and thoroughness is especially essential today. We're looking at the Pi network.
A crypto phenomenon. And when the signal-to-noise ratio is this low, I mean, when you have literally millions of people engaging with a project based mostly on hope and some very simple mechanics, you need the tools to cut through the marketing.
Absolutely. The noise around this one is, well, it's deafening. And it's deafening precisely because the promise is so appealing.
It's a powerful promise.
It is. Easy entry into the world of cryptocurrency ownership with mining that requires nothing more than, a simple daily tap on your mobile phone. For a lot of people, this represents the ultimate democratization of digital assets.
And it removes all the traditional barriers. No expensive rigs, no massive energy bills.
It's participation.
And that ease of entry, it fundamentally changed the landscape. You think about traditional crypto, it requires capital, it requires specialized hardware, a high level of technical know-how.
For sure.
Pi Network just swapped all that out for social capital and, persistent daily engagement. And the sheer scale of global participation, we're talking millions of users, it just proves that the appetite for accessible crypto ownership is absolutely immense.
But the sources we've gathered, and we have a mix of technical analyses, community deep dives, and some economic reports, they don't just stop at the feel-good story of global adoption.
No, they zoom right in on the core structural and economic red flags.
Exactly. So our mission today is laser-focused on one specific massive concern: understanding the distinct meaning and, frankly, the dire implications of coin inflation within the context of the Pi network. We want to contrast that big, accessible promise with the really serious economic and structural concerns raised in this material.
It's not enough to just say the project is risky. That's too simple. We need to dissect why the risk manifests so uniquely here.
What do you mean by that?
Well, you have a network that has successfully built a colossal user base, and by extension, a colossal supply base, all while it's still transitioning from a very centralized development model to what they hope will be a robust open ecosystem.
So the pressure created by that transition is where the real problem is.
The economic pressure is immense.
Okay, let's unpack this.
What?
Before we get to the economic threats, we have to understand the mechanism. What exactly is the Pi network? Who's behind it? And what are those millions of people actually doing when they tap that app every single day?
We have to start there. We need to start with the origin story and the mechanics of how this supply is even created.
Right. Understanding the creation of the supply is absolutely key to understanding its eventual devaluation risk.
It's the whole ballgame.
So Pi Network positions itself as a revolutionary blockchain-based cryptocurrency. And what immediately distinguishes it in the, often anonymous world of crypto is its clear academic origin. It was launched back in 2019 by a team of Stanford University PhDs. And this academic pedigree, frankly, it provides an initial layer of serious intent and credibility that a lot of these fly-by-night projects just don't have.
That's a crucial foundation. And the stated goal, their ambitious goal, right from the very start, was to solve the problem of inaccessible cryptocurrency adoption.
Right.
They recognized that Bitcoin mining was just out of reach for, 99% of the world? So Pi was designed to circumvent all that technical complexity. The intention was to be a global currency that relies on a social network consensus rather than, raw computational power.
And the mechanism they engineered for that is really central to this whole conversation around coin inflation. They called it eco-friendly mining.
It's simple, almost deceptively so.
It is. The whole point is to encourage mass adoption. A user downloads the app and performs a simple check-in, literally pressing a single button once every 24 hours. And the source material confirms that the accrual of PiCoin continues even when the phone is idle.
Which is what fundamentally differentiates it from traditional power-intensive mining.
Right. But this is where we need a bit more technical clarity for you. When the material says you're spending zero computational power, what does that actually mean?
It means that Pi Network doesn't use the energy-intensive proof-of-work system like Bitcoin does. Instead, it utilizes a mechanism that's based on the Stellar Consensus Protocol, or SCP, but it's a modified version.
SCP. Okay, that's a critical detail. That elevates this a bit. How does the Stellar Consensus Protocol enable this, zero power mining just conceptually?
Well, the Stellar Consensus Protocol doesn't rely on every computer in the world agreeing by doing expensive calculations. It relies on localized agreement within what they call quorum slices.
Quorum slices, so trusted circles.
Basically, yeah, trusted circles. For Pi Network, this translates into a social trust model. You don't prove your work through computation. You prove your trustworthiness and security through your established relationships and your daily interaction within the network.
So that eliminates the need for mining hardware.
Completely. It makes it accessible to any smartphone user anywhere in the world. But, and this is the important trade-off, it exchanges computational risk for a reliance on human behavior and identity verification.
And that model,
Yeah.
exchanging computational proof for social proof, that's the genius behind its viral growth. You are heavily, heavily incentivized to expand those trusted circles, your personal network, through referrals.
Exactly. The entire system is engineered for exponential adoption. Our sources clearly indicate how this plays out economically. For example, using a referral code, the material cites 1JP8biz. It offers the new user a substantial 25% increase to their base mining rate.
That's a huge boost.
It's an immediate, tangible benefit for both the referrer and the new person, and that just drives massive, rapid growth in the overall user base, which of course is simultaneously driving up the total coin supply.
So we're talking about millions of people accumulating this coin just by tapping a button and bringing their friends in. It sounds remarkably easy, maybe too easy.
And that leads us to the critical commitment that's required. It's not a free pass. There are really rigid registration and identity requirements that are tied to the future value of those coins you're mining.
Right. The system mandates identity confirmation.
Correct. The core vulnerability of any social trust model is what's called a Sybil attack.
Where one person creates hundreds of fake identities to game the system.
Exactly. So to combat that, users must register using their true legal names. This is not optional, it's mandatory.
And this leads to that next mandatory requirement that after you successfully complete 30 of these daily mining sessions, users have to pass a crucial identity step, the KYC process.
Know your customer.
Know your customer.
The KYC is the gatekeeper. It is the mechanism the network uses to verify that the person accumulating the coins is a real, unique human being, not a bot, not a duplicate account. This is the difference between accumulating, let's call it phantom Pi, and real Pi.
And only the real Pi becomes migratable to the mainnet.
Only after KYC confirmation, correct.
But the sources flagged a serious penalty structure here that I found pretty jarring, especially for a platform that's all about democratization and accessibility.
It's very strict.
Wait, a 20% loss just for incorrect registration? That seems incredibly harsh for a user who's just trying to follow a simple process. What does that policy tell us about their true goals here?
Well, that 20% penalty, which the sources explicitly mention for incorrect registration or, failure to pass the subsequent KYC, it tells us two things.
Okay.
First, the network is intensely serious about identity verification. They view every unverified coin accumulated by a bot or a fake account as potential structural damage to the network's future integrity.
So it's about protecting the value for the real users.
In theory. Second, it demonstrates a strong, centralized control mechanism. In established decentralized networks, penalties like this are typically executed through community governance or smart contracts, not through a top-down mandate from the core team.
So the high barrier to anonymity and the threat of loss underscore that while accumulation is easy, commitment to identity is mandatory.
Yeah.
And the stakes are high.
Right. It's a method of controlling the eventual supply that actually makes it to the usable blockchain.
Okay, so we have this massive KYC verified user base, and the project is now in the critical phase of launching its main network, or mainnet. They are migrating these confirmed coins into a usable blockchain environment. But that transition is happening right alongside the continuous exponential accumulation of new coins, which is the structural source of our primary concern.
And that massive pre-existing and constantly growing supply, just waiting for the demand switch to be flipped on, creates enormous potential for market saturation.
And that immediate potential for overwhelming supply leads us directly into the heart of our deep dive. We have to clarify the economic threat of coin inflation because we are dealing with a really distinct definition here.
This is critical. We have to pivot here because this conceptual clarity is essential.
When most people hear the word inflation, they immediately think of things getting more expensive. The general price level rising in traditional macroeconomics is what we hear about on the evening news.
Right, that's standard market inflation. It's defined as the increase in the general price level of goods and services, and it results in the currency's purchasing power decreasing. It's primarily a demand side or a cost push issue related to goods.
But in the specialized language of Pi Network and these pre-mainnet crypto projects, the sources make a crucial distinction. We're discussing cryptocurrency inflation or coin inflation.
Correct. For you, our audience, this is the definition that matters. Coin inflation is defined strictly as a massive or uncontrolled increase in the total number of coins or tokens in circulation, the total supply.
So it's purely a supply-side problem. Doesn't matter what the price of bread is doing.
Not at all.
And this rapid supply increase sets up the core, unavoidable devaluation mechanism. If Pi Network's growth model is successful in bringing in millions of users, it is, by definition, successful in creating millions, potentially billions of new coins.
And the problem arises when that sheer quantity of coins increases significantly without a proportional corresponding increase in legitimate demand for those coins.
Demand as a medium of exchange or a store of value.
Exactly. If supply outstrips demand, the physics of value dictate the result. The value of the individual coin decreases. It has to.
It's basic economics.
If a centralized authority, or in this case a successful viral referral mechanism, doubles the available number of tokens in the ecosystem every 6 months, but the number of actual transactions or utility use cases remains stagnant, then every single coin held by every user is systematically diluted.
And the project itself, somewhat ironically, states that it aims to solve the problem of inflation.
But the sources provide that crucial caveat. They can only fully implement controls after the cryptocurrency matures.
That timing is the fundamental gamble, isn't it?
It's the whole bet. They are essentially saying, we're prioritizing the creation of a massive user base and a colossal coin supply now in this growth phase, and we're betting the house that future utility and adoption will somehow materialize, catch up, and absorb that supply later once the network reaches maturity.
So the current inflation isn't an accident.
Not at all. It is the necessary side effect of their rapid growth model, but it is simultaneously the biggest structural threat to the early users who are doing all the accumulating.
So the users, therefore, are shouldering the entire risk of this massive coin creation process. They're putting in their time, they're giving up their identity verification, all in the hope that the future market will validate their accumulated stack of coins.
Which leads us directly into why Pi's inflation is particularly problematic. It's not just that the supply is going up, it's the lethal context around it that creates this triple threat to the coin's future viability.
These three factors, when you combine them, they create a systemic weakness.
They really summarize the major challenges that Pi Network must overcome to transition from a curiosity to a functioning currency.
Okay, so the first one, the one we keep circling back to, is the rapidly increasing coin supply. The sources state that the amount of Pi coins has increased significantly in a short time. This is the direct intended outcome of that easy mining and viral referral system we just talked about.
Right, and let's analyze the implication here for someone who started mining back in 2019. Every single newly created coin, whether it's mined by a referral you brought in or just a brand new user somewhere else in the world, it actively reduces the potential future value of your previously existing coins.
It's like a company issuing massive, constant amounts of new stock options.
That's the perfect analogy. Even if the company's valuation stays completely flat, your percentage ownership of the total market capitalization shrinks with every single new issuance.
So it creates this peculiar psychological deflationary pressure on the user's effort. If you spend years diligently tapping that button every day, and the current value of your accumulated Pi is constantly being diluted by the onboarding of millions of new participants,
then those pioneer coins you mined may end up being worth far, far less than you anticipated. It actually punishes the early adopters who did the hard work of building the network in the first place, unless that demand curve dramatically changes trajectory.
which creates this critical dissonance. The user feels productive because their personal number of Pi coins is going up on their screen.
But the structural reality is that the potential value per coin is systematically being driven down by the very success of the network's adoption model. It's a race against the clock for utility to materialize and outpace the rate of supply growth.
And that failure of utility to materialize yet takes us to the second major concern: the lack of widespread practical use, or what we can call the utility void.
This is the core reason why demand is not keeping pace with this avalanche of supply.
Precisely. To really understand the gravity of the utility void, we have to compare Pi to established cryptocurrencies.
Let's take Bitcoin, for example. Bitcoin has established utility as a store of value, as a hedge against traditional financial systems, and as a final settlement layer. Its fixed, predictable supply schedule validates its function as digital gold, especially during periods of, banking uncertainty.
Or look at Ethereum. Its utility is in being the fundamental gas, the fuel that's required to run decentralized applications, smart contracts, the entire DeFi ecosystem. You need Ether to engage in lending, borrowing, or creating new tokens.
That utility creates constant underlying demand regardless of speculation.
And Pi Network, in its current state, has not achieved anything close to that level of functional necessity.
Not yet. And without robust, real-world demand for the coin demand that's rooted in necessity, not just hope, its valuation is purely speculative and highly vulnerable to a rapid collapse.
If the only reason people hold the coin is the hope that someone else will pay a high price for it later.
That's not value. That's a speculative bubble waiting for the pin.
And the sources really drive this risk home by mentioning these related articles discussing the fantastical $314,159 value being categorized as a hoax.
It's almost ironic, isn't it?
It is. The community tries to assign this astronomical valuation clearly based on internal wishful thinking, and it's immediately debunked by any external analyst who looks at it.
And that massive gap between the community's desired valuation and the cold, hard economic reality. It just demonstrates the severity of the utility void. If the network is generating millions of coins, but hasn't yet provided a compelling, indispensable reason for an external party to buy or use those coins.
The entire structure is resting on the hope of future utility, not proven use.
Exactly.
Which brings us to the third piece of this triple threat. The centralization concerns. We know established crypto is decentralized. I mean, that's the whole point of blockchain, right? To distribute control across the community through consensus.
Yet, the sources identify Pi Network as remaining largely centralized, specifically during this critical development phase.
Meaning that development, code modifications, key decision-making about the network's future, and crucially, the timing and parameters of the open mainnet launch.
It's all concentrated in the hands of a few people, the core Stanford team.
Now, I had to challenge that point a little bit. If the core centralized team is composed of Stanford PhDs, doesn't that academic credibility and expertise actually mitigate the centralization risk, at least initially? Isn't a smart, credentialed team better than a faceless, potentially incompetent, or even malicious group of developers?
That's a really important nuance, and yes, academic pedigree certainly suggests serious intent and competence, but it doesn't solve the structural problem of centralization in the long term, especially in cryptocurrency.
Why not?
Because decentralization isn't just about avoiding bad actors, it's about anti-fragility, the ability of the system to correct and survive in the face of inevitable, unforeseen challenges.
Meaning that if a decision is wrong, the community can't force a correction.
Exactly. This structure limits critical market correction feedback loops. In a truly decentralized system, the community can vote on proposals, they can audit the code, they can pressure development forks if the core team makes an economically unsound decision.
Like one that exacerbates inflation.
Precisely. If the core team controls all the levers, they might not be responsive to the economic feedback that's required to mitigate the inflation problem before it's too late. Centralization, regardless of the team's pedigree, translates into a higher degree of singular execution risk.
So the entire fate of that vast accumulated supply rests on the judgment of a very small group.
That's it.
Okay, so to summarize the structural threat, we have colossal supply creation driven by a viral model. We have no widespread transactional demand yet to absorb that supply. And we have centralized control that limits the network's ability to pivot quickly if that utility doesn't materialize.
That's a very precarious setup.
It is the ultimate tightrope walk. They successfully built the supply base, but the infrastructure to support its value is still under construction.
Very much so.
So now, in this next section, we have to synthesize this for you, our listener. What do these interconnected issues mean practically for the user who has invested time, identity, and, hope into tapping that button for months or even years?
If we connect this to the bigger picture, the consequences translate directly into value depreciation and trust erosion. This is the payoff of the risk assessment.
The first direct consequence is the falling price. It's the unavoidable outcome of high coin inflation outpacing demand. The number of Pi coins increases relentlessly, driven by that successful mass adoption, which structurally drives down the value of each individual unit unless that commensurate proportional demand materializes.
And this poses a direct fundamental financial risk. The sources warn that coins that you have been accumulating over a long period may have a much lower value in the future than you originally anticipated.
So the time and identity commitment you invested today might not translate into an equivalent future economic reward.
Yeah, not at all. And this is why analysts classify this as a high-risk venture. It's not speculation on a price increase, it's speculation on whether the utility can beat the clock of supply dilution.
And furthermore, this structural volatility leads to the second consequence, the loss of trust. Unlike traditional assets, cryptocurrency value is built entirely on confidence. It's the communal belief that the network will function as advertised and that its governance is sound.
And high inflation, combined with lingering centralization concerns, acts like a corrosive agent on that confidence.
How so?
Well, if Pioneer users see their accumulated stack continually diluted, or if the market keeps questioning the core team's centralized structure and their ability to transition to open governance, faith in the project collapses. The material is explicit on this. If people lose faith in the future of the project, the value of the coin will drop dramatically, and potentially instantly.
We have to remember that the initial bootstrapping phases of crypto history were full of these high-risk ventures. But projects like Bitcoin had mitigating factors, right?
Right. They had the mitigating factor of a deflationary fixed supply schedule and instant decentralization, which makes the risk profile very different. Pi is unique because it combines this massive, ongoing pre-mainnet supply creation with centralized control.
And that combination is what pushes the risk profile to the edge.
It is. The sources conclude that it is very difficult to predict how the value of Pi will evolve. When you layer the high inflation, the inherent supply issue with the network under development, the missing demand infrastructure, the resulting probability of loss is defined as very high.
So for you, our audience, this is the essential takeaway. Until utility is proven at scale, the structural analysis places this firmly at the far end of the risk spectrum.
That is a necessary and a sobering assessment based on the economic design choices the project made during its growth phase.
However, a proper deep dive requires us to explore the counter-narrative and the mitigation efforts. We have to look at what they're actually building, the ecosystem in development. What tangible efforts are the project and its massive community making to overcome this utility void and create real demand to counter this immense supply?
This is the critical pivot point. The existence of the supply is a known risk. The creation of utility is the only known solution. The core thesis for Pi Network is that they seek to increase the intrinsic value of Pi by encouraging users to create and use decentralized web applications, or DApps, on the platform.
So utility, they hope, must be grown organically, powered by the users themselves.
That's the idea.
And the sources provide concrete evidence that this utility creation is actually happening, at least on a community level. They explicitly name PiBazar.eu as the first community bazaar in Europe facilitating peer-to-peer sales using Pi currency.
The significance of the PiBazar cannot be overstated. This proves that transactional demand is being attempted before the open mainnet is fully established and before major, recognized exchanges have listed the coin.
So the community is effectively acting as its own closed or semi-closed economy.
Yes. To validate the coin's fundamental function as a medium of exchange. They are testing whether Pi can actually facilitate real commerce.
And, crucially, the scope of what they are attempting to exchange is incredibly broad. They aren't just trading digital vouchers or, NFTs. They're attempting to facilitate trade in physical, high-value, and even regulated goods.
The breadth of categories detailed in the sources paints a remarkable picture of ambition.
It really does. We see categories aiming for massive market penetration and logistical complexity. The list includes practical necessities and luxury items, auto, house garden sports, electronics, PC mobiles, and cosmetics drugstore.
These are physical, tangible goods. They require shipping, quality assurance, dispute resolution. This isn't simple stuff.
And the ambition goes even further, including services work, etc., and high-value items, jewelry, watches, valuables.
And then we get to the really challenging ones, the regulated categories.
Right. Clothing, alcohol, cigarettes, and the 18-plus category.
Focusing on those high-value and regulated items gives us a critical insight into the community's intent. Why list jewelry or autos? Because those transactions require significant trust and the transfer of high notional value. That tests the coin's ability to act as a serious store of wealth, even if it's just temporary during the transaction.
And what about the regulated stuff? Alcohol, cigarettes?
Well, those categories introduce complex logistical challenges regarding legality, taxation, age verification. For a decentralized, closed network to attempt to facilitate trade in regulated goods, they must be developing, or at least attempting to develop, robust mechanisms for escrow and compliance.
So the existence of the PiBazar and its detailed list of these high-stakes categories, it's a tangible signal that the community is aggressively trying to build transactional demand that can match the existing supply.
It directly addresses the utility void problem. They are trying to create a gravitational pull for Pi.
They are trying to turn users from mere accumulators into active consumers and merchants using Pi.
Yes, and that is the difference between having a lot of lottery tickets and actually having cash.
Furthermore, the sources show that the network is acutely aware of the financial scrutiny they're under. They mentioned tracking PIUSDT live trading volume on gate.io and analyzing Pi balances and KYC funds on exchanges.
And this is significant because it indicates they are watching external market signals, even if the coin isn't fully open for global trading yet.
So they're preparing for the financial reality check.
It seems so. Analyzing KYC-verified fund movements and tracking speculative trading volumes suggests they are gauging the level of pent-up supply and the speculative appetite out there.
And the future outlook that's cited in the related articles reinforces this intense focus on network maturation. The sources point toward a concentrated effort on open network and ecosystem development in 2025.
That 2025 timeline is the target for validating their entire economic model. They are explicitly talking about when the financial engine revs up and citing goals like holiday commerce breaks records.
So this isn't just development talk. It's a strategic plan to transform the accumulated supply into actual shopping power.
The vision is to successfully transition from the easy mining phase, which created the supply, to the real shopping phase, which creates the sustained demand.
And this brings us back to the central paradox we started with. Despite the explicit structural warnings of high risk, massive inflation, and centralization, there is an active, documented, and highly ambitious community effort
Evidenced by the PiBazar and the stated 2025 development goals.
to create the necessary transactional demand that is supposed to save the coin's value.
It is a phenomenal high-stakes balancing act. The high risk doesn't come from a lack of effort. It comes from the fact that if these utility efforts, the dApps, the complex commerce initiatives, the compliance efforts, if they fail to generate demand at a scale capable of absorbing millions of accumulating users,
Then the pre-existing centralized supply will instantly crash the value.
but if they succeed, it validates the risk model of rapid mass adoption first, utility second.
The structural tension here is just incredible. It's one of the highest expressions of risk versus potential reward we've analyzed in a while.
Exactly. Our audience now holds both sides of the coin. The incredible accessibility and viral growth engine that created this massive supply, and the inherent structural vulnerabilities, both economic and governance related, that threaten to render that supply worthless if the utility switch isn't flipped in time.
So what does this all mean for you, our listener? Let's recap the core takeaways. We've seen the sheer scale of participation, the innovative easy mining model that relies on social consensus through a modification of the Stellar Consensus Protocol.
And that mandatory, harsh KYC process used to control the legitimacy of the ultimate supply. That's the ambition.
That is the project's ambition to create global digital currency access.
And we've contrasted that ambition with the severe structural warnings. We defined coin inflation specifically as supply inflation, which is driven by the very success of their adoption model.
And this colossal supply is combined with a current lack of widespread necessary utility and a centralized decision-making structure.
Leading analysts to conclude there is a very high risk of loss.
The ultimate fate and value of the Pi coin, then, unlike traditional established cryptocurrencies that had either a fixed supply from the start or immediate decentralization, is deeply tied to its ability to transition successfully.
It must move from a centralized development stage where the supply was created to a fully functional, widespread utility platform.
And this platform has to be robust enough, handling everything from auto sales to regulated goods, capable of absorbing the immense supply created by millions of mobile miners before their patience, or the market's patience, runs out.
That ability to successfully transition is the singular metric of success. If Pi can move beyond merely being an app you tap daily and become a currency you genuinely need to use to conduct real-world business, the structural risk mitigates itself.
Until then.
Until then, the centralization and the high supply remain an intense economic headwind.
Which leads to our final provocative thought for you to consider and explore further. We have established that the project explicitly aims to solve this inflation crisis after the cryptocurrency matures. But given the unique structural risks, the centralization and the immense closed supply, what specific, measurable milestone beyond the community-run bazaars and the release of new dApps would unequivocally signal to the global market that the Pi network has truly reached that critical maturity phase, effectively mitigating that high risk of loss.
That's the key question. Would it require a definitive open-source governance model being enacted, or maybe the successful audited integration of a financial engine capable of managing escrow for high-value physical goods?
Or is it just simply the consistent, large-scale, non-speculative transactional volume on the open market?
Understanding the answer to that question requires looking at how successful disruptive networks prove sustained utility, not just initial enthusiasm. That is your homework.
As always, we are providing the information and the analysis distilled from the sources, but we have to reiterate the critical disclaimer embedded in this material.
Yes, investing or engaging with cryptocurrencies carries an inherently high level of risk and is subject to significant price fluctuations. Please conduct your own extensive research and proceed with caution.
Be informed, be critical, and continue to look for those critical connection points in every new piece of information you receive. That's our deep dive for today. We'll see you next time.